Hi, this is Sean R. Roberts, your success partner, welcoming you one more time to the 2016 Mastery of Success Wealth Bootcamp. We have one of my special favorite guests here, Dr. Perry Hopper, who is going to talk to you about financial concepts. One of the things that we brought you here, this intimate setting, to teach you how to expand your economic and income base and create more cash, but not only create more cash, but create more influence. Now the next level is really for you to figure out, how do I strategically use that influence to create long-term sustainable wealth? So I encourage you to sit back, listen to what Dr. Hopper has to say, and then at the end, ask him questions. And then when you get an opportunity to talk to him privately, ask him questions. And then network with some other people here who are very great at finances. Brady's name's been thrown around. Lionel's name's been thrown. Lionel knows how to work a dollar. So, without further ado, I introduce to you Dr. Perry Hopper.
Thank you very much.
Oh, yeah, as well.
All right, thank you so much. Good to be with all of you and to be a part of this, Sean, and to have the invitation to join with you. I'm excited about being with millennials because it makes me feel like I'm maturing and I'm getting older and older, which is the case. 57 years old, been with the organization that I serve with in ministry called MMBB, Financial Services Ministry, for 30 years come next March. So I started there when, or maybe even before, some of you were born, but don't all laugh at once. So good to be here, and I do want to start by talking a little bit about who MMBB is. MMBB, it's really the acronym for Ministers and Missionaries Benefit Board. And we have a 105-year history. How about that? That 105 years has included a migration from being a pension fund, retiring pension fund, which gave out grants, to what it is today, which is a variable annuity plan that is invested for the long term. Our primary audience are clergy, preachers, pastors, itinerant preachers, revivalists, evangelists, denominational executives, etc., those who serve in the clergy, the clerical ministry, as well as those who serve in the churches, church musicians, secretaries, custodians, finance administrators, etc. So we cover them, and we provide these benefits. At the time they retire, they are able to live off of this for the remainder of their lives. And they can place their annuity not only in terms of their own lives, but they can also position it to be paid to their surviving spouses. We manage $2.5 billion in assets, and we have 18,000 members worldwide. The vision for MMBB started with Henry Morehouse of Morehouse College fame, right? Henry Morehouse was secretary of the Home Mission Board for American Baptist Churches, and he decided, at that time it was called the Northern Baptist Convention, and it was his passion. And I like to hear that word passion among millennials and young people, because it really does set the tone for how you will live out your life. And we all ought to have a vision for how we live out our lives. His vision was that preachers would retire with dignity, because so many of them were retiring and they were living off the largesse and generosity of other people. So hand-me-down clothes, chicken dinners, grocery bags were given to preachers when they retired, and he said they really ought to, after a life of service, ought to be able to retire with a bit more dignity than that. And so his vision was that the denomination would begin a pension fund from which people would be able to draw lifetime income. He sent out an appeal, not only within the denomination, but beyond the denomination, to business leaders, captains of industry during that time. And this was the early 1900s. And of course, one of the big names at that time was John D. Rockefeller, who was himself a Baptist. And he left the church in Midtown Manhattan and came uptown and built a church called the Riverside Church. Okay, that's all Rockefeller money. But he also wanted to help seed this vision by Henry Morehouse. And it was Rockefeller and another gentleman who remained anonymous, his name was Milo Treat, who really gave the seed money that began the endowment of MMBB. And at that time, they gave $10 million. That was a lot of money, of course. You can index it for inflation from the 1900s until today. And now the endowment is over $200 million. And out of that endowment, we're able to pay the salaries of staff, and we're able to do some other things beyond the contract of annuities that people purchase. Okay, we have an emergency assistance charity fund. We are also able to fund a lot of our operation, like build in a new computer system and cybersecurity, which we're currently engaged in right now. So one of the great stories of MMBB, aside from the gifts of Rockefeller and others who died and left plenty of money to the board, is the story of Martin Luther King Jr., who was preaching and protesting and advocating in the Deep South and across the nation, but had no benefit whatsoever to leave to his family. The concern was great. We had a field representative at that time. His name was Martin England, who was sent into the South specifically to enroll ministers who had no benefits whatsoever and were at risk. Okay? So it became very difficult, as you know, Dr. King being who he is, or who he was, it was difficult to get close to him. He had plenty of lieutenants, Wyatt T. Walker, Andrew Young, and others around him. And so Samuel Proctor of Abyssinian Baptist Church called Wyatt T. Walker and said, listen, you all let this man get close enough to King so he can get some insurance and some benefit for his family. We know he's at risk, and this gentleman is trying to sign him up. Well, over time, Martin England was able to get to Ralph Abernathy and said, I need to get to Dr. King to get him into this plan. He prevailed, and in 1967, in September, Dr. King signed the application for MMBB membership in pencil and on the back of Ralph Abernathy. We have that application on file. It's in the safe at MMBB for historic reasons. That was September of 1967. We all know what happened in April of 1968, that Dr. King was killed. From that moment on, MMBB provided a benefit to Coretta King and children's allowances and college education to each of his 3 children. And she received a benefit as a widow until she died in 2006. Okay? So that's one of the great stories of MMBB, and there are dozens of others like that. We also, Sean, cover Pastor Taylor. Okay? We cover Calvin Butts over at Abyssinian. We cover James Forbes at Riverside, and the list goes on and on. So we've had a strong history, and it's one that we are proud to be a part of. I really want to talk more today to you about long-term perspective when it comes to wealth. One of the things one of our professors said to me in business school when I was doing my MBA, he said, if it's on your back, it's not in the bank. And then he said, if it's on it's not an asset. Okay? You can take that out if you want, but I simply wanted to say that for the point of emphasis that too many of us think of our money and we don't think of the long-term perspective in terms of putting something away for the future. If an old man or an old woman is going to live well, a young man and a young woman has to prepare for them today. Okay? If you're going to live well in the future, you have to prepare for it today. I want to talk a little bit about Joseph. We all know the story of Joseph and how he was sold into Egypt by his brothers, right? The boy with the coat of many colors, right? You can read in the book of Genesis chapters 37 through 50, and it gives you the entire story of who Joseph was and what he was all about. But I want to talk a little bit about his character of leadership. What were the characteristics he had? One, he was humble. The power and prestige of working for Pharaoh never changed him. Two, he was principled. He had integrity. He was tempted many times, even by Potiphar's wife, but he resisted. Three, he was disciplined. He had proper long-term perspective even while he was in prison. And he was in prison for the wrong reason. Faithfulness. While in jail, he remained faithful to God and never wavered from his commitment to God. Grace. He showed grace and mercy, even to his brothers who sold him, after he revealed himself to them. Competence. He did his job with excellence. Wise. He had wisdom beyond his years. He was only 30 years old, but demonstrated a seasoned perspective. And then, perhaps most importantly, Joseph was strategic. He was a dreamer, yes, but he was strategic. Joseph was a planner, and he prepared the nation for famine, even through the years of plenty. And so while you have it, this is the time to plan. I recall a young preacher coming to me, and I'm going to talk about preachers a lot today because that's who I work with. A young pastor came to me, and he said, you know, how can I get $1 million? You know, how can I gain and grow $1 million? And I said, well, you need to begin by putting money away today. So let me tell you about this retirement plan that we have. And he said, well, I don't need that. I said, you're the very person who needs it. He was 22. When I started with MMBB, I was 28. And I'm glad that someone yanked my coattail and said, this is the time while you're single, no family, this is the time for you to begin putting money away at the maximum rate. Once you're married, once you have children, you have the family responsibilities. Once you buy a home, you got that. But this is the time while you're single and without a family that you need to be putting money away and putting it away at the maximum level. I'm glad I took his advice. I haven't looked back since. And today, even after the dot-com bubble, even after the Great Recession, I'm doing okay. All right, I could retire tomorrow and be all right for the rest of my life. But you don't get there overnight. The time to do it is now. When we talk about our money story, and I can have this PowerPoint sent as well, okay? We talk about the money story. We can talk about what did you learn about money growing up, because all of this factors into how you see and understand money today. Was there enough money in your household? Were there often arguments about money? Because this does color your perspective. Did you get an allowance, or were you just allowed to live there? I don't know. Were you bribed with money? Did you have to do something in order to get it? Did you get a job to support yourself or your family as a teenager? I know I've been working since I was 14 years old. Now, I grew up in a family of 13 children. They don't have that anymore, do they? 13 children. And yes, there was television, but, you know. I don't know how my mother and father did it, but I do know that it was very difficult on my father's income as a common construction worker to make ends meet. And so many of us had to get out and begin working at an early age, not only to help support the family, but even to support ourselves, buying our own school clothes and all that. And there were times when there was nothing. And so if you want to talk about being poor, I was poor. P-O, poor. Okay? Po. I'll just put it out there. Okay? You know, it was real. But one thing that mother and father always taught us was they induced in us a sense of thrift. That for every dollar that you're making, you need to put a certain percentage aside. Okay? The pair of jeans that you bought at the start of the school year, the few pair of jeans, they're not going to be wearing the same in the spring. Okay? And so you're going to need to have something to go out and buy some new clothes. But they encouraged savings, bank accounts, thrift, so that you thought about the future. Okay? And you began planning. So early on, that was something that was drummed into us. They also told us about tithing to the church. Now, God doesn't need your money. I said that. He doesn't. But if God has your heart, he can get your money. Okay? The whole concept of tithing was in Israel, it was meant to remind the people that God made this possible. Put God first. That's what tithing is all about. Now, is it 10% on the gross or is it 10% on the net? Do you want the gross blessing or do you want the net blessing? That's my question. Okay? It doesn't matter. Tithing is about putting God first in everything that you do because everything comes from God. I believe that. So, did your family give money to the church or to other charities? What little we had, we gave a little to the church to remember God first, who made it possible. I want to say a little bit about MMBB because the Lilly Endowment has recently given MMBB a $1 million grant, and we're in line for a second million, okay, to help foster this issue of financial wellness and literacy among clergy. We go to seminary. I did 3 years in a master's program at Harvard and then 3 years in a doctoral program at United Seminary in Dayton. And none of those programs talked about finance. Not one. And yet more money passes through the hands of preachers and churches than any other institution or business that we have or own. Okay? So I was surprised. And there's lack of understanding among many pastors and churches, particularly pastors, about finance and business. Okay? Many of them do understand it, but many of them do not have the literacy. So there are also a number of clergy who are leaving ministry within the first 5 years because they are so financially stressed. They come out of seminary with extreme debt, averaging $30,000 to $40,000, and then they go to a church which can minimally afford to pay them, okay? So the stress of trying to make ends meet, dealing with the stresses of members in your church, preaching every Sunday, going to hospitals, going to prisons. Many of them are saying, you know, this is just a little too much for me. So we're noticing an increasing number of clergy who are dropping out of ministry within the first 5 years. Okay? And they find another passion that they're interested alternatively. So the consumer stress debt index that I'm putting here demonstrate that pastors are 2.5 times more likely to be stressed about debt than the rest of society. Okay? And I dare say this is true even among millennials, and this is only increasing. The 4 questions which probe stress from all consumer debt sources: credit cards, mortgages, home equity loans, car loans, student loans. Okay? And using a 5-point scale, the survey elicits the following: There's a frequency of worry over debt, the amount of stress from debt, the extent of expected problems from debt over the next 5 years, and there's a concern about the inability to ever be able to get out of debt. And debt, my friends, is the new form of slavery. And if we aren't careful, we're back in slavery again, okay? You're not free until you get out of debt. Now, there may be some good debt and some bad debt, right? Good debt, perhaps a mortgage, if the markets behave as they're supposed to, right? And that's not always the case today. A 30-year mortgage may not appreciate at the same rate as a 30-year mortgage back when my mother and father bought their house in 1970. Now, you finance folks in here, you can corroborate this or correct me or whatever, but it's a different animal now than it used to be. So, where do we start? And we're going to talk today about income. We're going to talk about expenses. Who do you owe how much? Interest rates and fees, and then savings. How much and where do I get started? Again, about credit, and I'm going to fly through some of this. Using credit creates debt, and the types of debt are secured debt, unsecured debt, and the important considerations always to think about are the amount, the term, and what is the rate. And I do have these sheets that I'm going to hand out to you, okay, to give you something to work with over time as you manage your own debt. Looking at this, let's just say you have $700 you owe on Nordstrom's. The rate is 18%, and we can go up and down the list. Best Buy, Sears, Visa Chase, Visa Citibank, a mortgage, and then Ford, meaning your car in terms of the credit debt. This is kind of typical, of what most people might owe. Then we have the rate of interest, and then we have the minimum payment that is owed on this. So if you want to talk about the debt management, you first need to identify what are all your debts, and then talk about what is the next step, planning how I attack the debt. And probably the best way to attack it would be to look at paying off the ones with the highest interest rates first, and then attacking the ones with the lowest interest rate. I mean, you might think, someone may think to pay $1,700 because that's the biggest one. Not necessarily so. You want to get to the ones that have the highest rate of interest. Attack that first, and then take whatever you'd been paying on that and put it toward the next debt, and so on and so forth. And you'll find over time you'll be able to eliminate your debts easier. Now, how well do you do the basics? And these are 3 questions you want to ask yourself, or 3 things you want to identify. I met with a couple who were about to retire, a clergy couple, and they had fairly meager earnings during the time of their career. They had been about 25 years in the pastorate, serving 2 different churches, and his income was not very high. Okay? When we finally unfolded all of their investments and their assets, we found that they had nearly $1 million that they had saved, that they had amassed by the time they came to retirement. How were they able to do that? They did it by disciplined savings, a little bit over a long period of time. I think the average age in here might be, I'm just going to guess, might be about 30, 32 years old, okay? Let's just say that's the case. You've got time as your best friend. If you don't, then there are some risks that you take by not taking the opportunity to save beginning now. And I have some calculators I'm going to hand out to you that will kind of give you a tool for, if I save at this level for this long a period of time, assuming a rate of return, how much will I have saved by the time I reach, say, 65? And then on the other side, it will show you the costs for waiting. If you say, well, I'll just wait and do that next year, okay? There is a cost to it. The question here is, are you able to live within your means? That's what this couple did. They stayed within their means. When they received any raise that he got, he put it away in savings, in investments. Smart move. How much do you save? 10%? 15%? 20%? I'd say within your 20s, you can start at 10%. Or if you're in your 30s and 40s, you can go 15%. And if you're in your 50s, you need to be saving at least 20% of your income. This kind of gives you an idea. But whatever you do, whether it's 5, 10, 15, or 20%, establish a savings plan and stick with it. Stick with it. I'm telling you, time value of money, it's on your side. Should I take a loan against it or withdraw some of it for emergency use? I was telling somebody earlier, drink a Coke, walk around the block a couple of times, and forget that strategy, okay? Do not mortgage your future income for present need. It hurts you in the long term. Here's another way to preserve income: risk management. Insurance. Common types of insurance that can help protect you and your assets from different risks. You all know this stuff. Health insurance. Don't think because you're young you can't get sick. Okay? It can happen to you. Married young couples and told them in their vows, in sickness and in health. Oh, yes. Young people can get sick too. Auto insurance. Life insurance. There are all types of life insurance. Property, if you own property. Liability, not just your property, but somebody who has an accident on your property. Okay? And disability, you're more likely to be disabled than you are to die before retirement. That's a reality. That's statistically true. And long-term care insurance may seem a long way off before you have to go to a nursing home, but you never know. You may run into a debilitating illness or become a caretaker that your medical insurance plan does not cover. Okay? These are things to think about. When you're talking about liability insurance, at minimum, you should have enough to protect the current assets that you have. And you may have all kinds of assets, not simply in investments, but also some real estate and other types. Consider additional coverage to protect the current future wages from any garnishment. Coverage typically obtainable up to $5 million. That's what's out there in the marketplace. And the cost is relatively inexpensive, $200 to $300 per year for every $1 million of coverage. Again, the types of life insurances that are out there or death benefit plans. One is term insurance. That's what we offer at MMBB, a term life insurance that decreases every 10 years, and it's based on a multiple of one's compensation. There's no cash value to that. The premiums are more expensive as one ages, and then useful if one needs a large sum to protect the family or the home during a short period of time. Now, I keep this a secret from my wife. She doesn't know how much life insurance I have through MMBB for obvious reasons. Don't y'all laugh at that. I'm worth more dead than I am alive, in other words. A whole or permanent life, cash value or savings component, premiums may be less than term, and there are often surrender charges for whole or permanent life. And you can even take out loans against that, although I strongly do not recommend that. Long-term care insurance generally covers long-term medical needs not covered by health insurance, Medicare, or Medicaid. Okay? Includes personal and custodial care, and the premiums vary greatly depending on the age, the maximum payout, the number of days, and so on and so forth. Long-term care insurance, from your perspective, is much cheaper at a younger age. The older you get, this gets more and more expensive. Okay? So, You're talking about protecting your assets. You need to think about the risk. Know your risk tolerance to potential financial liabilities that are not covered. Look for discounts because there are plenty out there for long-term care policies. Periodically review, as you should, everything, including investments, what your insurance is, and talk to the insurance company to see if you're properly covered. And many people make the mistake of not reviewing their insurances. For example, I sold my home last year, and I had a life insurance policy on that. I looked at it. I looked at the life insurance that I have through the employer, in addition to the additional travel insurance that I had, and I found I was overinsured. Okay, so our family does. It's only a family of 3, my wife and son. Okay, so we tank that down and save some money. But you need to be reviewing this on a regular basis. So let's talk a little bit about retirement planning, which is really the space that I'm in. You're a long way off from retirement. I said to a group of seminarians who were looking to get to their first pulpit, first call to a church, that when you get your first call, you need to have the end in mind. How are you going to leave a place? Now, there are some persons who their experience in ministry is going from church to church. But when you come to a place, you need to have some idea of how you're going to leave it. How are you going to grow it? What impact, what legacy do you want to leave on this ministry? One thing I like about the pastor of Community Baptist Church, he says, I'm not going to be here after a while, okay? I do have plans for retirement. And then there are others in ministry who you have to drag out of the pulpit, kicking and screaming, because they've been there so long and they did not think about one day this is going to be over, okay? And then there are pastors who die out of the pulpit, unfortunately. But then their widow is still there, who is first lady. And believe me, churches become very different in their attitudes toward the first lady once the pastor's gone. I can say that flat-footed, okay? And there's nothing left for her. In most cases, that's what it is. And they pass the hat around, and they'll make a love offering, but that will only last for so long. So what will the end look like? You should have some idea of that when you come to your work and career. When you come to retirement, and I really like one colleague of mine, Winona Green. I was with her last evening, my wife and I, and we were talking about how good she looks in retirement. You know why? Because Winona planned well. She has yoga classes, she has golf outings, a strong social life, church life where she's involved in her church. She makes a contribution, sowing into young persons like yourself. So she did it well. She had an idea when she was going to retire and how that retirement was going to look. What does your retirement look like? Think about it now, and you can start planning. Is it no work? Is it part-time work? Is it doing the same work, but in a different venue? Some people say they want to, pastors say that when they retire, they're going to do interim churches. They're going to be with a church that is still looking for a pastor, but they need somebody to serve for 1 or 2 years until they get to their next call. What does it look like? Does it mean living in your dream home? Where are you going to live? Bahamas? Tahiti? Virginia? Where are you going? New York City may be too expensive. Philadelphia may be too expensive. Maybe not. No debt? Are you going to travel? Take up new hobbies like yoga. Financial planning for retirement is about reaching your goals, whatever they are. But you need to establish goals. And I'll tell you now, if you don't write them down, they're not goals. Okay? They just live up here. And that can be fluid. But write your goals down. Be very clear about your aspirations. At what age do you want to retire? Now, this gets a lot of attention from people. Everybody thinks about when they're going to retire. Am I going to be eligible for Social Security, or am I going to take early Social Security? Now, some of us want to retire tomorrow, right? If we could. But think about that. Where do you want to live? And are your goals smart, specific, measurable, attainable, relevant, and timely? Okay? According to the Social Security Administration, 1 out of every 4 retirees will live past the age of 90, and 1 out of 10 will live past the age of 95. Social Security was never meant to be the long-term benefit program that it is today. When the Roosevelt administration started it back in World War II, most people were not living to the age of 65. The life expectancy tables were very different. In fact, President Roosevelt himself died at 64. Okay? So he didn't get it. Most people didn't. That changed. Better health care, better practices by people. And today our life expectancy, I think, is somewhere around 80-something for, I think it's 83 for men and 85 for women. Okay, that's the current tables. So we're doing pretty good. However, the fund has to be positioned to pay out over all of those lifetimes. And that's the issue of the solvency of Social Security. What will they do in the future? Who knows? They might raise the age again. I know for me, it's 66 years and 10 months. That's 67, basically. What is it for you? Not exactly sure, but I think it's past 67, okay? They might raise it to 70. Financial planners like to manage investments so they will last 30 years in retirement. And what will you do with all that time? We're back to that original question of what will retirement look like for you? So, and when you talk about retirement planning, the issue here is never put off for tomorrow what you can do today. Again, the time value of money works in your favor. There's this thing called the rule of 72. I'm sure you all know about it. Every 7 years, your money can double, given whatever the rate of return is you assume to that. And again, start with the end in mind. So here's a table. Joanne and Joe, years of active saving, 20 years. In order to reach $76,472 in retirement, Joanna will put away for 40 years $50. Okay? That's the monthly amount. Total amount saved, assuming a 6% rate of return, would be $12,000, and it will end up at $76,472. For Joe, however, he has only 20 years because he started later. And he has to put in $165 in order to get to the same $76,472. So the later you wait, the more money you have to put away. That's the downside of waiting and saying, I think I'll just wait until a couple of years, or wait until I pay off this, or wait until I pay off that. Does not work in your favor. Start with something. That's the key. And how much is enough? It may take $600,000 to $1.8 million for you to retire and keep the same quality of life you have right now. If you have capital worth about 12 to 15 times your gross annual income at 66, this would put you in a position to live on about 80% of your pre-retirement income. And that's, I think, the bogey of most financial planners. 75 to 80% of current income is where you should be when you retire. How do you calculate where you are now? You simply take this table and your age and take a multiple of your annual income that you should have saved. So if you take 0.10% times your current annual income, that's what you should have saved by the time you reach the age of 26, and so on and so forth. And I found using 7.2 at 56 that I was pretty close to where I should be. And you might be surprised by this when you use this calculator. You also might be surprised to find that you are a bit behind, but there's nothing wrong with that entirely. Just forgive yourself and get started. Don't be discouraged because, again, the time value of money will be a real friend to you. You have a goal, but now what you need to do is get off the idea and take action and get started. Back to the earlier comment about setting a goal at 20, you're in your 20s, you should be saving about 10% of your income. Your 30s, about 12%, in 40s and so forth, 15. In the 50s, you should be saving 20% of your income. So figure out what your savings percentage is now and increase that amount by 1% each year until you reach your savings goal. That's one approach. Another approach is one I spoke about earlier. If you are so blessed to get a raise, live on the current income and put all of your raise away into savings. But evaluate your goal